All right, let's dive into another deep dive. This one, well, it's all about working capital management,
Oh, yeah.
which I know, it might not sound like the most filling topic, but it really is fascinating once you get into it, especially from the perspective of businesses here in India.
Right.
So we've got a really interesting mix of sources for this one. We've got excerpts from a working capital management textbook, kind of like the foundational stuff.
Oh, yeah.
We've got some publications from the RBI, always good to get their perspective.
Mm-hmm.
And then we've even got some recent articles from the Indian financial press just to see, like, what are the hot topics right now, you
Yeah.
know?
Yeah.
So our goal is to really understand how this all works, how businesses can make smart decisions about their working capital.
Absolutely. It's not just about the theory. It's about the practical application.
Right, exactly. So if we think of a business as like a big complex machine,
Mm-hmm.
working capital is kind of like the fuel, the oil that keeps everything running smoothly.
Yeah, it's the lifeblood of the business, you could say.
Okay, yeah, I like that, the lifeblood. Now, the textbook, it throws around a few different terms for working capital, like gross working capital and net working capital.
Yeah.
Could you break those down for us? Like, what's the difference and why should we care?
Sure. So gross working capital, that's basically all of your current assets. Things like your cash on hand,
Okay.
inventory, what your customers owe you.
Right.
But net working capital, that's where things get really interesting.
Okay.
That's when you take your current assets
Mm-hmm.
and you subtract your current liabilities. So what you owe to suppliers and others,
Oh, I see.
it's a measure of your short-term financial flexibility, basically.
So it's like how much wiggle room you have to cover your immediate expenses and maybe even, make some strategic moves.
Exactly. It's your financial cushion.
Okay, I like that, the financial cushion. Now, the textbook also highlighted a few key characteristics of working capital that make it so, dynamic and important. It mentioned short lifespan,
Mm-hmm.
swift transformation,
Yeah.
and interconnected asset forms.
It's constantly in motion, that's for sure.
So, like, cash is turning into inventory, inventory is getting sold and becoming
Receivables?
receivables, yeah. And then hopefully those receivables turn back into cash, right?
It's a constant cycle.
It's like a financial dance. It's all these different elements flowing and transforming.
And it's happening fast. Most of these components, they have a lifespan of less than a year.
Oh, wow. Okay.
Yeah, so it's a short timeline.
So you can't just set it and forget it. You got to stay on top of it.
You got to be nimble, for sure.
Right, right. And then there's that interconnectedness, right? Like if one piece of the puzzle gets messed up, it can affect the whole system.
Absolutely. A delay in collecting receivables, for example, can impact your cash flow,
Right.
which then might affect your ability to purchase inventory.
It's all connected.
It's a delicate balance.
Okay, so we've got this intricate dance of resources
Mhm.
all happening within a tight time frame. Now, imagine you're running a fast-growing tech startup, right, versus, say, a traditional textile manufacturer.
Mm-hmm.
Wouldn't their working capital needs look totally different?
Oh, absolutely.
Mm-hmm.
I mean, the patterns of working capital growth, the challenges they face, it varies so much depending on the industry.
Okay. Okay.
So a one-size-fits-all approach just won't cut it.
Mm.
You need a strategy that's tailored to your business.
Right, it makes sense. Okay, so we've got to talk about the big I word, inflation.
Ah,
It affects everything. I mean, I'm guessing it throws a wrench into working capital management as well.
It does. Inflation can increase the amount of working capital a business needs.
Okay.
Rising input costs, you need more cash just to buy the same amount of raw materials.
Right.
And then if demand's strong, you might want to expand your operations.
Sure.
But that takes even more working capital.
Uh-huh.
And then there's this temptation to stockpile inventory just in case prices keep rising.
Oh, yeah. Like, I better buy it now before it gets even more expensive.
Exactly. It's a chain reaction.
So inflation's putting even more pressure on this delicate dance of resources we've been talking about.
Mm-hmm.
Speaking of pressure, what about managing cash during inflation?
Right.
Because the textbook mentions something about idle cash actually losing value.
That's a crucial point, especially in India where, we've had our fair share of inflation.
Right.
Money just sitting in a bank account, it's losing purchasing power.
Oh, I see.
It's like it's like keeping your money under the mattress. It's slowly shrinking.
Yeah.
Savvy businesses understand that cash needs to be working and needs to be generating a return.
Okay, so it's going to be part of the dance, not just sitting on the sidelines.
Okay.
Now, we can't just talk about inflation in a vacuum, we got to consider the Indian context. What makes working capital management different here in India?
Well, India's unique economic environment definitely plays a big role,
Okay.
including its monetary policy. The Reserve Bank of India, the RBI, they're a key player here.
Right. The arbit.
They influence everything from interest rates to how much credit is available.
Okay, yeah. I've been seeing a lot of headlines about the RBI lately,
hmm
especially about their shift from what they call direct to indirect instruments of monetary control.
Right.
Now, that sounds pretty technical,
It is a bit, yeah.
but I bet it has real implications for businesses, right?
It does, definitely.
Right.
So in the past, the RBI, they used to directly control things like, how much banks could lend
Okay.
and who they could lend to.
Mm-hmm.
But now they're relying more on these market mechanisms.
Okay.
So, for example, they'll adjust interest rates to influence borrowing costs
Okay.
and control inflation.
So if I'm a business owner and I need a loan,
hmm
the interest rate I get is going to be heavily influenced by what the RBI is doing.
Exactly.
Yeah.
They're setting the stage, so to speak.
Okay, so instead of dictating the terms, they're setting the stage, and businesses need to be aware of how those stage directions are changing.
That's a good way to put it, yeah.
And it's not just about controlling inflation, right?
No, not at all.
The RBI also uses specific tools to encourage growth in certain sectors, right?
They do. They offer something called concessional rates,
Okay.
which are basically lower interest rates for sectors they consider priorities.
Okay.
Think of agriculture,
Mm.
small and medium enterprises, things like that.
Oh, okay.
These lower rates make borrowing more affordable, and that encourages investment and growth.
So they're trying to steer the flow of capital towards where it's needed most.
Exactly. It's all part of India's development goals.
That makes sense, yeah. But it's not just domestic factors at play here, right? We've got globalization too. How's that impacted working capital management for Indian businesses?
Globalization has definitely brought both opportunities and challenges.
Mm-hmm.
One thing our source mentioned specifically was the devaluation of the rupee,
Right.
which, it can be a double-edged sword.
Okay.
On the one hand, it can make Indian exports more competitive because they'd be cheaper for buyers in other countries,
All right.
but it also makes imported raw materials more expensive for Indian businesses.
So it's a balancing act for sure.
Absolutely.
So Indian businesses are navigating a pretty complex landscape here, right?
Mhm.
Rising costs, fluctuating currencies, evolving policy directives from the RBI.
It's a lot to juggle.
It is. So that brings us to a really crucial question. How does a business in this environment, how do they figure out how much working capital they actually need?
That's where strategic planning comes in. The textbook outlines 3 different approaches to determining your working capital needs.
Okay, lay it on us. What are they?
So the first approach is called the industry norm approach.
Okay.
It's basically looking at what your competitors are doing and trying to match them.
Okay.
It's a simple approach, but it can be limiting.
Right, because you're not really thinking for yourself. You're just following the crowd.
Exactly.
Yeah.
It might not be the best strategy if you're trying to be innovative or disrupt the market.
Okay. What's the next approach?
The second approach is called economic modeling.
Okay.
This one involves using a lot of formulas and calculations
Right.
to try to pinpoint that optimal level of working capital for your business.
Oh, that sounds like it gets pretty complex.
It can be, yeah. It's data intensive, but it can provide more precise results.
Okay, so it's for the number crunchers out there.
Yeah, exact.
What's the third approach?
The third approach, and this is the one I find the most interesting, is called the strategic choice approach.
Okay, now we're talking strategy. Tell me more about this one.
So this is where you align your working capital management with your overall business strategy.
Okay.
Are you aggressively trying to gain market share?
Mm-hmm.
Are you focusing on maximizing profitability?
Mm-hmm.
Maybe you're prioritizing steady, sustainable growth. Your working capital strategy needs to support those bigger objectives.
So it becomes a proactive tool, not just a reactive thing.
Exactly. It's about being strategic and intentional.
I love it. Okay, this has been a fantastic overview of kind of the working capital landscape.
Mm-hmm.
But now let's get down to brass tacks. Let's talk about the specific components of working capital, like the building blocks of this financial dance.
Let's do it.
Okay, so we'll start with receivables, which is basically the money your customers owe you.
Right.
But I have a feeling there's a lot more to it than just sending invoices and waiting for the checks to roll in.
You're right. It's a lot more nuanced than that.
Okay, so what are some of the potential pitfalls of receivables management? What should businesses be watching out for?
So there are two key risks associated with receivables:
Okay.
opportunity loss and liquidity risk.
Okay. Break those down for us. What do those actually look like in a business?
All right, so opportunity loss, that's when you're too strict with your credit terms. You might miss out on potential sales because customers are turned off by your requirements.
Oh, I see. Yeah.
And then on the flip side, you've got liquidity risk.
Mm-hmm.
That's when you're too lenient with credit.
Okay.
If customers don't pay you on time, you could end up in a cash crunch.
So it's about finding that balance between like attracting customers and protecting your own cash flow.
It's a delicate dance.
All right. So how can businesses manage those risks effectively? Any practical tips?
Well, the source we have here highlights this great framework called the 5 C's of credit analysis.
Okay, the 5 C's. I like it. What are they?
Okay, so we've got character, capacity, capital, collateral, and conditions.
Character, capacity, capital, collateral, and conditions. It's
Okay.
like a checklist for evaluating a customer's creditworthiness.
Exactly. You're basically assessing their track record of paying debts, their ability to generate income,
Okay.
their overall financial stability,
Mm-hmm.
and even like the broader economic conditions that might affect their ability to pay you back.
So you're really digging deep, doing your due diligence.
It's like being a financial detective.
I like that. Yeah. What about businesses that like deal with a high volume of customers or more complex credit situations? Is there anything else they can use to manage their receivables?
Definitely. There are various credit evaluation models that businesses can use.
Yeah.
These models, they use statistical analysis
Mm-hmm.
to try to predict the likelihood of a customer defaulting on their payments.
Oh, interesting.
Yeah, so it can help businesses streamline their credit decisions and manage risk more effectively.
It's like having a data-driven crystal ball
Kinda,
to
yeah.
try to predict customer behavior.
Exactly. The key is to find the right tools that work for your business.
All right, we've tackled receivables. Let's move on to cash, which is the lifeblood of any business.
Absolutely.
But isn't holding on to too much cash kind of like, stashing it under the mattress? You're not really putting it to work.
Right, there's a balance to strike.
Okay.
Having too much cash means you're missing out on potential returns. But having too little can leave you vulnerable if there's a sudden expense or, a dip in sales.
So how does a business find that sweet spot? Not too much, not too little, just the right amount of cash.
The textbook breaks down the motives for holding cash into 3 categories:
Okay.
transaction, precautionary, and speculative.
Okay. The 3 P's of cash. Let's hear it.
All right, so the transaction motive, that's the most straightforward.
Okay.
You need cash to cover your day-to-day expenses, like paying bills, salaries, things like that.
That's the fuel for the engine, right?
Exactly.
What about precautionary? What's that all about?
Precautionary motive is about having a buffer for the unexpected.
Okay.
Maybe there's a sudden drop in sales, or a piece of equipment breaks down.
Mm-hmm.
Having that cash reserve can help you weather those storms without having to, scramble.
So it's like an emergency fund for your business.
Yeah, exactly like that.
Okay. And then speculative.
Speculative is all about holding cash to seize opportunities that might come up.
Yeah.
Maybe there's a chance to acquire a competitor or invest in a new product line.
Mm-hmm.
Having that cash on hand allows you to act quickly.
So you're ready to pounce when the right opportunity comes along?
Exactly.
I'm starting to see how cash management is more than just, balancing the checkbook.
Oh, it's much more than that.
It's about strategic thinking,
Absolutely.
planning for the future.
Being proactive.
All right, let's move on to the last piece of our working capital trio, inventory,
Oh, yeah.
which is all about having the right goods on hand to meet customer demand, right?
Right, but it's not always as simple as it sounds.
Okay, so what makes inventory management so complex?
Well, you're constantly trying to balance having enough stock to meet demand,
Right.
but also avoid unnecessary costs.
Oh, yeah, because holding too much inventory can get expensive.
It can, definitely.
So what are the key things businesses should consider when managing their inventory?
The source we're looking at breaks inventory costs into 3 categories:
Okay.
ordering costs, carrying costs, and shortage costs.
Yeah. Okay, let's hear about these 3 costs.
Okay, so ordering costs, those are incurred every time you place an order for new inventory.
Right.
It's not just the cost of the goods themselves, it's processing the order, shipping fees, receiving the goods, all of that.
So it's all the behind-the-scenes stuff that adds up?
It does, yeah. Then you've got carrying costs.
Okay.
Those are the costs of storing and managing your inventory,
Mm-hmm.
things like warehouse rent, insurance, and even the risk of things becoming obsolete or spoiling.
Right. So the longer you hold on to something, the more it costs you.
Exactly.
What about shortage costs? What are those?
The shortage costs, those are what you incur when you run out of stock.
Okay.
Lost sales, obviously,
Right.
disappointed customers,
Yeah.
and potentially damage to your brand reputation.
Ouch. Yeah, nobody wants that.
No, definitely not.
So it's like this three-way tug of war,
Mhm.
businesses trying to minimize all three of those costs.
Exactly. It's about finding that sweet spot.
So how do you find that sweet spot? Any helpful tools or strategies?
Right. One concept that can help is the economic order quantity, or EOQ.
EOQ.
It's a formula that helps businesses determine the optimal order size that minimizes the total cost of ordering and carrying inventory.
Okay, that sounds useful, but I'm guessing it's not just a plug-and-play solution, right?
Right. It's a good starting point.
Okay.
But you also need to consider things like lead times from your suppliers, how much demand fluctuates,
Okay.
even your storage capacity.
So it's more than just a number. It's about understanding the bigger picture.
It's about context.
Are there any new trends in inventory management that are, like, shaking things up?
Oh, absolutely. Things are changing rapidly.
Okay.
We're seeing innovations like just-in-time inventory management
JIT.
and advanced supply chain management techniques.
Okay, so JIT, that's about getting materials only when you need them for production, right?
That's right, which minimizes waste and reduces storage costs.
That sounds pretty efficient.
It can be, yeah.
And what about supply chain management? How's that evolving?
Well, supply chain management is all about optimizing that entire flow of goods
Okay.
from your suppliers to your customers.
Mm-hmm.
It involves working closely with your suppliers,
Okay.
tracking inventory in real time,
Mm-hmm.
and using data analytics to anticipate demand.
So it's about having greater control over your entire inventory ecosystem.
Exactly.
All right, we've talked a lot about managing working capital, but we haven't really addressed, like, where does the money come from in the first place? How do businesses actually finance their working capital needs?
That's a great question, and it's a crucial part of the puzzle.
Okay.
Businesses have a few different financing options, both short-term and long-term.
Okay.
And the key is to match the funding source with how long you need it for.
Oh.
Short-term needs, short-term financing. It's called the matching principle.
Makes sense. So what are some of the most common financing options that businesses use?
All right, so some common short-term options include bank credit,
Okay.
trade credit, commercial paper, and factoring.
Okay. Bank credit, that's pretty straightforward, right? You borrow from a bank, repay it with interest.
Exactly.
But what's trade credit?
Trade credit is basically an interest-free loan from your suppliers.
Oh, okay.
You purchase goods or services now and pay for them later, usually within a certain time frame.
So you're getting some breathing room there.
Exactly.
What about commercial paper?
Commercial paper is it's a type of short-term debt that large corporations issue,
Okay.
typically to finance, short-term things like payroll or inventory
Right.
and factoring. That involves selling your receivables to a third party at a discount.
Okay.
So you get cash right away,
Uh-huh.
but you're giving up some of the profit.
So there's a trade-off there.
There is.
So it's all about, like, choosing the right tool for the job, right?
Absolutely. Each option has its pros and cons.
Okay. Now let's focus on a specific type of business that's crucial to the Indian economy.
So?
Small and medium enterprises, or SMEs. They're the backbone of the economy, but they often face some unique challenges when it comes to working capital management.
You do, especially because they often have limited access to formal financing.
Okay.
They rely a lot on owners' capital, and they can be really vulnerable to changes in government policies.
So it's a different ballgame for SMEs.
It is, for sure.
So what are some key things they should be focusing on?
For SMEs, cash flow management is absolutely crucial.
Okay.
It's like navigating a small boat through rough waters. Got to be really careful.
Right. One wrong move and you're in trouble.
Exactly. And one of the biggest risks for SMEs is overtrading.
Overtrading, what's that?
Overtrading is when a business expands too quickly without having the financing to support that growth.
Okay.
They might take on too many orders, invest too heavily in inventory, things like that.
So they're getting ahead of themselves, basically.
Yeah, and it can put a huge strain on their working capital.
Right, leading to that cash crunch we talked about.
Exactly.
So what can SMEs do to mitigate that risk?
Well, first and foremost, they need to be really meticulous with their cash flow forecasting.
Okay.
They need to know what's coming in and what's going out.
Right, and try to anticipate those dips and peaks.
Exactly. They also need to be cautious about their credit policies.
Okay.
Make sure they're not extending too much credit and putting their own cash flow at risk.
So being careful and strategic with who they're doing business with.
Absolutely.
Now, are there any, like, government programs or initiatives that can help SMEs with these challenges?
Yes, there are. The Indian government has implemented a number of schemes to support SMEs,
Okay.
including access to credit, training programs, even tax breaks.
Oh, wow, that's great to hear.
It shows that the government recognizes how important SMEs are to the economy.
Yeah, they really are the backbone, aren't they?
They are, absolutely.
All right, so for SMEs, it's about being extra careful with that cash flow,
Mm-hmm.
making the most of those support programs, and choosing sustainable growth over like rapid expansion.
Exactly. It's about building a solid foundation for the long term.
Okay, this has been a fantastic look at the fundamentals of working capital management.
Yeah, it's been a good overview.
We've talked about the key components, explored different financing options, and even focused on the unique challenges that SMEs face here in India.
Mm-hmm.
But there's so much more to uncover,
Oh, definitely.
especially when we consider how dynamic the Indian business environment is and all the global forces at play.
It's an exciting time to be in business.
It is, so stay tuned for part 2 of our deep dive, where we'll continue this exploration and equip you with even more insights.
Looking forward to it.
I am too.
So, building on what we were talking about with SMEs,
Mm-hmm.
working capital management, it's not a one-time thing.
Right.
It's an ongoing process. You got to be constantly adjusting.
Yeah, it's like, what's a good analogy? It's
Yeah.
like a balancing act, right? You're constantly shifting.
It is. It is.
Adjusting to the market, to the economy, to your own goals, yeah. And speaking of balancing acts, one of the most important parts of this is finding that balance between risk and return.
Oh, absolutely.
The textbook used this analogy of investing surplus cash in marketable securities as a way to, like, put your cash to work, make it earn something.
Right. Instead of just letting it sit there.
But doesn't that, like, expose the business to potential losses?
It does. There's always risk involved.
Okay.
The key is to understand your risk tolerance, right?
Mm-hmm.
And choose investments that align with your goals.
Okay.
If you're risk averse, you might choose something that's low yield but stable.
Right, right.
But if you're comfortable with more risk, you might go for something with higher potential returns.
Even if it's a bit more volatile.
Exactly.
So it's all about, like, what's your comfort level?
Finding that balance.
Yeah, and that balance is going to be different for every business,
It will be, yeah.
depending on their industry, their growth stage, all sorts of factors.
Your overall strategy, yeah.
Right. Now, the textbook also mentioned this concept of the operating cycle, which is like the time it takes to convert your investments and inventory into actual cash.
Right, from cash to cash, basically.
So the shorter that cycle, the less working capital you need tied up.
And that's the idea.
So if you're like a fast food restaurant,
Mm-hmm.
turning over inventory quickly,
High volume, quick sales.
yeah, managing working capital might not be as critical.
Right. But if you're a construction company with these long-term projects.
Yeah, that could take months or even years.
Exactly.
Then efficient working capital management becomes absolutely crucial.
It's make or break.
Right, and that's where, what was it, forecasting?
Yes, forecasting.
That becomes so important.
You got to be able to predict those cash flows
Yeah, so you know what's coming in, what's going out,
as accurately as possible.
which can't be easy, especially in a market like India.
It's definitely a challenge.
So are there any tools or techniques that businesses can use to get a better handle on their forecasting?
Oh, there are a bunch.
Yeah.
The source mentions everything from simple cash budgets
Well,
to these more complex statistical models.
okay, cash budget, that sounds pretty basic.
It is, yeah. It's basically a projection of your cash inflows and outflows,
Okay.
usually over a month or a quarter.
So you can see, like, are there going to be any tight spots coming up?
Exactly.
What about those statistical models? Those sound more high-tech.
They are, yeah. They use historical data
Mm-hmm.
and algorithms
Okay.
to identify patterns and trends in your cash flow,
Oh, that's interesting.
so you can generate more accurate forecasts.
It's like having a crystal ball, but it's based on data.
In a way, yeah.
Of course, no forecast is perfect, right?
Never perfect, no.
But the more accurate you can be, the better prepared you are.
Absolutely. You can anticipate those ups and downs.
And we can't talk about the future of business without talking about technology.
True. It's changing everything.
Yeah, I mean, it's creating all these opportunities to streamline, improve efficiency, and free up working capital.
Huge potential.
Like, think about electronic payments. That's been a game changer.
Oh, yeah.
Businesses get paid faster.
Mm-hmm.
Less reliance on those costly short-term loans.
Speeds up the whole cycle.
It's a turbo boost for your cash flow.
I like that, yeah.
And then there's all these cloud-based accounting platforms that are
Lovely.
popping up everywhere.
Real-time access to your data.
Anytime, anywhere.
Make decisions faster.
It's like having a virtual CFO in your pocket.
That's a good way to put it.
And then data analytics, that's a whole other level.
Oh, yeah, that's powerful stuff.
Businesses are using it to like unlock all these hidden insights and optimize everything.
It's incredible what you can do with data now.
So you're not just relying on like gut feelings anymore.
Nope, it's data-driven.
You can make smarter decisions about your receivables,
Mm-hmm.
your inventory, your credit policies.
The whole picture.
Okay, so we've talked about all these different tools and strategies,
Mm-hmm.
but let's step back for a second
Okay.
and address the fundamental why.
The big question.
Like, why should businesses even care about working capital management?
That's a good point. It's easy to get lost in the details.
What's the big payoff?
Well, at its core, it's about making the most of your resources,
Okay.
making sure you have the flexibility to seize opportunities,
Right.
to navigate challenges,
Mm-hmm.
and ultimately achieve your goals.
It's like having a well-oiled machine.
Exactly.
All the parts working together smoothly.
And in today's world, where things are changing so fast,
Yeah, it's constant change.
working capital management is essential for survival.
It's not a luxury anymore. It's a necessity.
Exactly.
Now, let's talk about India specifically.
Okay.
You know, it's a region that's been seeing amazing growth and innovation.
For just citing market.
It is. But what are some of the unique challenges and opportunities for businesses here when it comes to managing their working capital?
Well, India has its own unique set of factors.
Mm-hmm.
Our source goes into some detail about, the regulatory environment, the RBI, other India-specific things.
Yeah, the RBI is a big one.
Definitely.
I mean, they have a huge impact on working capital management,
They do, yeah.
setting interest rates, controlling inflation, regulating credit.
They're the puppet master, in a way.
Right. And remember we talked about their shift from direct to indirect control.
Mm-hmm. Big change.
So how does that shift actually affect businesses in their day-to-day operations?
Well, interest rates now play a much bigger role
Okay.
in how much it costs to borrow money.
So businesses have to be more savvy about managing their debt.
Exactly. And they need to stay informed about what the RBI is doing.
Right, because those policies can have a ripple effect.
They can, yeah.
Mm.
But the RBI isn't just about controlling things.
Okay.
They're also trying to promote growth in certain sectors,
Right, we talked about that.
like agriculture, SMEs.
Using those concessional rates.
Exactly.
So it's like they're trying to guide the flow of capital
Yeah, using incentives.
toward areas that need it most.
Smart strategy.
But it's not just the RBI, right? The
Yeah.
government's also been busy,
Oh, yeah. Lots of reforms happening.
making it easier to do business in India,
Cutting red tape,
simplifying regulation,
attracting foreign investment.
so a more business-friendly environment overall,
That's the goal.
which is great news. But are there any, remaining challenges that businesses need to be aware of when it comes to working capital?
There are still some hurdles, yeah.
Okay, like what?
Well, financing is still relatively expensive in India
Okay.
compared to a lot of developed economies.
Mm-hmm.
Higher interest rates can put a strain on businesses.
Yeah, especially if you're relying on loans.
Exactly. It cuts into your profits.
What else?
Delayed payments are another big issue.
Oh, yeah, I've heard about that.
It's not uncommon for businesses to have to wait weeks, even months, to get paid.
Which messes with your cash flow,
Big time. And it's a huge problem for SMEs.
because they often don't have a lot of cushion.
Exactly.
So what can they do about it?
Well, they can try to be more proactive with their receivables.
Okay.
Set clear payment terms, follow up with late payers.
That's on top of it.
Yeah, and maybe look into using those online payment platforms.
Oh, yeah, those can speed things up.
They can,
What
definitely.
other challenges are there?
Well, the volatility of the rupee is another factor.
Oh, right, the exchange rate fluctuation.
Exactly. It creates a lot of uncertainty.
Especially for businesses doing international trade.
Yeah, because it impacts the cost of imports and exports.
Makes it hard to plan, right?
It does, for sure.
So you've got to factor that into your working capital strategy.
How could be adaptable?
Are there any other India-specific challenges that come to mind?
One more, and it's a big one. Infrastructure.
Okay.
While India's made a lot of progress, there are still gaps.
Oh, right, like in transportation.
Yeah, that can lead to delays,
Mhm.
disrupt production,
And unreliable power,
forces you to invest in backups.
which adds to your costs.
Yeah, exactly. It all impacts your working capital.
So working capital management in India,
It's like navigating a maze.
it is lots of twists and turns.
Unique challenges, unique opportunities.
But the rewards can be great.
Yeah, for those who can adapt.
Absolutely.
Now, what's really helpful is to look at real-world examples,
See how others have done it?
Yeah, case studies?
Exactly. Our source has a few interesting ones.
Okay, which one should we start with?
Well, there's a fascinating one about Paytm.
Oh, yeah, the digital payments platform.
Mm-hmm.
They've been growing like crazy.
They have, and managing their working capital has been key.
I bet it's a whole different ballgame for a digital platform.
It is, yeah.
What were some of the challenges they faced?
Well, one big one was needing a huge cash balance
Oh,
to facilitate all those payment transactions.
makes sense, yeah.
And they also had to deal with the risk of fraud.
Oh, right. Security is paramount in that business.
Absolutely.
So how did they handle all of that?
They did a few smart things.
Oh,
They partnered with multiple banks
okay.
to diversify their funding sources. Smart spread the risk
Exactly. And they invested heavily in fraud detection systems.
to protect themselves and their customers.
Yeah, and they automated a lot of their processes
To improve
to
efficiency.
reduce errors.
So, Paytm's story shows how technology, partnerships, and risk management all play a part.
They're all interconnected.
What other case studies stood out to you?
Well, there's one about Tata Consultancy Services, TCS.
Oh, yeah, one of the giants of the IT world.
Global player.
Managing their receivables must be a massive undertaking.
It is, especially with customers all over the world.
Different currencies, different payment terms, different cultures.
It's a lot to keep track of.
So how do they do it?
They implemented a centralized receivables management system.
Okay.
Gives them real-time visibility.
Oh, I see.
Automates collections, tracks payments globally.
So they're on top of it.
Always.
What about currency risk? How did they handle that?
Hedging, mostly.
Okay, using financial instruments to protect themselves.
Exactly.
Oh.
And negotiating good payment terms with their customers.
To ensure that steady cash flow.
Predictability is key.
So TCS shows the importance of having robust systems in place, especially when you're operating globally.
Can't just wing it.
No, you got to be organized.
Absolutely.
What other case studies did you find insightful?
The one about Maruti Suzuki was really interesting.
Oh, yeah, the car manufacturer.
Hmm.
Inventory management must be a huge deal for them.
It is. They have a very complex supply chain.
Right. Tons of raw materials, components, finished goods.
Got to keep it all flowing.
So what did they do to optimize their inventory?
Well, they used just-in-time inventory.
JIT, yeah, we talked about that.
And they also did vendor-managed inventory.
Okay, what's that?
That's where the supplier manages the inventory.
Oh, interesting.
So Maruti Suzuki doesn't have to do it all themselves.
That frees up a lot of resources, I bet.
It does, and they also focused on building strong relationships with their suppliers.
Collaboration is key.
Absolutely.
So they're working together to make sure everything runs smoothly.
That's the idea.
Maruti Suzuki's case really highlights how technology, processes, and partnerships
All working together.
can turn inventory management from a headache into an advantage.
Absolutely.
What other case study did you want to mention?
The last one is the State Bank of India, SBI.
Oh, right, the biggest bank in India.
They play a huge role in financing businesses.
I bet, especially for SMEs.
Definitely. And they've developed a lot of specialized lending products.
Okay, so they're trying to cater to the needs of different types of businesses.
Exactly. They offer working capital loans, term loans, export financing.
So they've got you covered no matter what your needs are.
Pretty much. And they've been really quick to adopt technology.
To make the whole process faster and easier.
Exactly.
It's great to see them supporting businesses of all sizes.
They're a vital part of the ecosystem.
Okay, so these case studies show us the diversity of challenges and opportunities in India, but they all highlight one common theme:
What's that?
adaptability.
Yes.
The business world is constantly changing.
It is, always.
The companies that can adapt quickly, they're the ones that thrive.
The ones that can roll with the punches.
Exactly. It's like navigating a river.
Stay afloat.
You're constantly adjusting course to avoid obstacles.
You got to go with the flow.
And if you're too rigid,
Too stuck in your ways.
you get swept away.
The current takes you.
Now think about the pandemic.
Oh, yeah, that was a huge test.
That was a real test of adaptability.
Forced businesses to rethink everything.
Supply chains were disrupted.
Sales plummeted.
Working capital cycles went haywire.
It was chaos.
But some businesses were able to weather the storm better than others.
The ones with a strong working capital foundation.
So how did businesses in India adapt to the pandemic? What did they do?
A lot of them focused on building up their cash reserves.
Okay, to create that buffer.
Exactly. They negotiated longer payment terms with their suppliers.
To ease the pressure.
Yeah. And they cut expenses wherever they could.
To preserve that precious working capital.
Every rupee counted.
So it was a time of, intense pressure, but also innovation.
People had to get creative.
Yeah, some businesses even pivoted, completely
Seems their whole model,
to survive.
adapt or die,
And the pandemic also highlighted another important concept,
which is,
sustainability.
yeah.
Not just environmental sustainability,
Right.
but also like building a business that can thrive in the long term.
Resilient.
And working capital management plays a big role in that.
Does, definitely.
A financially sustainable business, they have that strong working capital position,
Allows them to meet their obligations.
invest in growth, weather those economic storms.
Prepared.
And a socially responsible business, they use their working capital to support things like fair labor practices, ethical sourcing, community development.
Giving back.
And an environmentally conscious business, they manage their working capital to minimize their impact,
Reduce waste.
promote sustainable practices.
It's all connected.
So it's about finding that sweet spot where financial performance, social impact, and environmental responsibility.
All come together.
Yeah. And it's not just about like feeling good.
Oh, it's good for business, too.
Businesses with strong sustainability practices, they tend to perform better,
They attract better talent.
build a stronger brand.
It's a win-win.
So sustainability is a smart business strategy.
Absolutely.
Okay, this has been an incredible deep dive so far.
We've covered a lot of ground.
We've gone from the basics to case studies to these bigger ideas like adaptability and sustainability.
It's all connected.
But before we move on to the final part, let's just distill some key takeaways.
Good idea.
So first and foremost, working capital management, it's not just about finance.
No, it's strategic.
It's about understanding how everything in your business is connected.
Making smart decisions.
And then effective working capital management, it requires that holistic approach.
Cash management, receivables, inventory financing.
All part of the same puzzle.
Can't ignore any piece.
And technology is changing the game.
Oh, yeah. Big time.
Data analytics, automation, it's all helping businesses optimize their working capital.
Becoming more efficient.
And finally, there's no one-size-fits-all solution.
Nope. Every business is different.
You got to tailor your approach to your specific needs and goals.
Find what works for you.
This deep dive has been a fantastic journey.
I've enjoyed it.
I can't wait to continue exploring this topic in our final segment.
Me too.
Hmm?
We'll delve into even more insights, talk about emerging trends, and give you some actionable takeaways.
Sounds good. So stay tuned for part 3 of our deep dive into working capital management. All right, so we've talked about the fundamentals, the challenges, some real-world examples. But as we wrap up this deep dive, I want to look ahead.
Is a future.
Yeah. What are the big trends, the big challenges that are going to shape the world of working capital management, in the years to come?
Well, one trend that's already making a big impact is AI.
AI, artificial intelligence.
Yeah, and machine learning. They have the potential to, revolutionize how we manage working capital.
Okay, how so?
Well, they can automate tasks, improve forecasting, give us these real-time insights.
It's like having a super-powered brain working for you.
Kinda, yeah.
Can you give us some specific examples of, how AI and machine learning are being used right now?
Sure. So AI-powered chatbots, they're being used to handle customer interactions,
Okay.
even automate parts of the collections process.
Oh, Angel.
And machine learning algorithms, they can analyze huge amounts of data
Right.
to find patterns in how customers pay,
Okay.
which can help businesses make smarter credit decisions.
So you're reducing that risk of late payments.
Exactly.
What other trends are you seeing?
Blockchain is another big one.
Blockchain. Yeah, I've heard that term a lot, but I'm still not quite sure I understand it.
It can be a bit confusing, yeah.
How does it relate to working capital management?
So imagine a digital ledger, right?
Okay.
And it records every single transaction in a supply chain, from when the raw materials are bought to when the final product is delivered.
Okay.
And this ledger, it's shared across a network of computers.
Okay.
So it's super secure, transparent, can't be tampered with.
So instead of all those paper invoices and manual processes,
Right, which are slow and prone to errors.
you're using blockchain to track everything in real time.
Exactly.
That sounds way more efficient.
It is, and it can also help businesses get financing.
Oh, how so?
Let's say you're a small supplier, and you need cash to fulfill a big order.
Okay.
You can use blockchain to prove to lenders that you're a good risk
Okay.
because they can see your track record of on-time deliveries and payments.
It's like a A digital resume for your business?
Kinda, yeah.
That's pretty cool.
It's a game changer, especially for smaller businesses.
We also talked about sustainability and how that's becoming more important.
Oh, yeah, that's a huge trend.
Investors are really looking at companies' ESG performance.
Definitely.
So how is that specifically impacting working capital management?
Well, companies with good ESG scores, they're seen as less risky,
Okay.
so they can often get better financing terms,
Well, interesting.
lower interest rates,
Makes sense, yeah.
and we're also seeing these new financial products,
Okay.
like green loans,
Even loans, okay.
sustainability-linked loans.
What are those?
Basically, they reward companies for hitting certain ESG targets.
So it's not just about doing good, it's good for your bottom line too.
It's both.
Okay, so lots of exciting opportunities on the horizon. But what about challenges? What are some of the things that are keeping business leaders up at night?
Well, regulation is a big one,
Okay, yeah, there's always new rules and regulations popping up.
and it's getting more and more complex, especially for global businesses.
It's like a constantly moving target.
It is, so you got to be proactive.
Monitor the changes.
Invest in
Yeah,
compliance.
make sure you're following the rules.
Otherwise, you can face big penalties.
And damage your reputation.
Nobody wants that.
What other challenges should we be thinking about?
Cybersecurity is huge.
Oh, right, with everything moving online.
Businesses are more vulnerable than ever,
To hacking, data breaches, all that.
and that can have a huge impact on your working capital.
Yeah, if your systems go down or you lose sensitive financial data, that's a nightmare.
It can cripple a business.
So what can businesses do to protect themselves?
Well, they need to invest in strong security systems,
Okay.
train their employees,
Make sure everyone's aware of the risks.
and have a plan in place if something does happen.
So you can respond quickly and minimize the damage.
Exactly.
Okay, so the future of working capital management is a mixed bag.
It is opportunities and challenges.
It's like sailing into uncharted waters.
I like that.
There's exciting discoveries out there,
New lands to explore.
but there's also hidden reefs and storms.
You got to be prepared.
So what's the key to navigating all of this?
Adaptability.
Adaptability, that's the word.
The businesses that can adapt, they're the ones that will thrive.
So any final tips for our listeners? What can they do right now to improve their working capital management?
First, take a good look at where you are now.
Assess your current situation.
What are your strengths? What are your weaknesses?
Oh.
Are you collecting receivables sufficiently? Is your inventory optimized?
Okay.
Do you have a cash management strategy?
So you got to know where you stand before you can make a plan.
Exactly.
Yeah.
And once you have that assessment, you can start building a strategy.
Tailored to your specific needs.
And don't be afraid to embrace technology.
Yeah, there's so much out there that can help.
Automation, analytics, it can make a big difference.
And remember, this is an ongoing journey.
It never ends.
You got to keep learning, keep adapting, keep improving.
It's like tending a garden.
I like that.
You got to nurture it, adjust to the seasons.
To make sure it flourishes.
Exactly.
Well, this deep dive has been incredible.
I've learned a lot.
Me too.
Yeah.
Working capital management, it's so much more than I thought it was.
It is fascinating,
Yeah,
really.
it is. And I feel like we've only just scratched the surface.
There's always more to learn.
But I hope this has given our listeners a solid foundation.
The basics, the challenges, some strategies for success.
And I encourage everyone to keep exploring this topic.
Read more, do your research,
Because knowledge is power.
especially in business.
Well said. It's been a pleasure sharing these insights with you and our listeners.
Thank you for having me.
And thank you to all our listeners for joining us on this deep dive into working capital management. We'll be back soon with another exciting topic from the world of business and finance. Until then, stay curious and keep those working capital engines humming.